Hello, this is Matthew Copley with Copley Financial Group. Today we're going to do a little market update, and today's not going to be great news because we're seeing a lot of bad economic data, but I want you to understand what we're looking at and how we're changing the investments in order to take into account all this new data. So first thing I want to mention is the multi-year guarantee annuity that we've been talking about. It looks like that promotional rate of 5.4% is going to be reduced. The applications must be in by tomorrow, so hopefully anyone who's interested, I know a lot of people that have already gotten into it are all set. It does have to be funded and issued by Friday this week. No worries if you don't take advantage of the current 5.4% 3-year rate. We do have another option that is currently at 5.15, and it's possible that we have another good insurance company that comes out with another higher rate sometime in the near future. Especially with some of the higher inflation data coming in, we may see interest rates continue to go up. So that said, let's talk about what we're looking at. Economic data is bad. This does not look good for the economy. It does not look good for investment accounts, and we're going to be positioning to kind of protect ourselves as much as possible. This is why I like this 5.4% so much. I think it's such a good deal because getting a guaranteed 5.4% with no fees and no risk for the next 3 years is probably going to end up being a good move. Some things we're looking at. ISM manufacturing data is horrible. We've never seen a number this low without a recession. So when you look at manufacturing data and you see how much manufacturing is dropping, this is a definite signal. It's a 100% signal on recession. Housing data, another thing, 100%. Never has there been a turn in existing home sales like we've had without a recession following. So we're seeing housing data signaling a recession is here. Third, besides housing data, is inverted yield curve. We have never seen the 2-10s invert without a recession following. Typically, that recession follows within about a year. Based on the 2-10 inversion, the recession should start somewhere between March of 2023 and January of 2024. Looking at that data, 100% accuracy, the last 10 economic recessions in the United States have all been signaled by the 2-10 inversion. So that inverted yield curve is pretty much signaling that we're going to have a recession. Now, just because we're going to have a recession doesn't necessarily mean that stock market is going to absolutely crash. Now, it could, but we also have an inflation problem. And this is continuing to show up in the numbers. CPI, PPI data continue to come in hotter than expectations. Even the PCE, which the Fed uses for inflation numbers, it came in at 5% in December. Now the new number is 5.4%. So for January, which means that not only is inflation not coming down, it's starting to trend up again. So the whole market recovery at the beginning of this year was based on the fact that the Federal Reserve got inflation under control and inflation was coming down and we weren't going to have as bad of inflation, so the market was recovering. Well, those numbers, there's been a lot of cold water poured on those numbers as far as inflation data. The PCE does not look good. We're seeing a lot of manipulation by the government in some of the data. Some things that we're seeing, for example, is spending was up 1.8%, consumer spending. Incomes were up 0.6%, and savings rate was also up. Wait a minute, how did that happen? Incomes only went up 0.6%, spending went up 1.8%, but somehow people are saving more money. Where's this money coming from if they're not taking out of savings? Doesn't make any sense. So take a lot of these government numbers with a grain of salt. A lot of it is based on adjustments that the government makes, a lot of inaccuracy in these numbers. So obviously we look at data from sources, from analysts at Goldman Sachs and JP Morgan and other sources that are giving us more accurate data. A lot of the government numbers are just to the point now they're being manipulated to try to fit a narrative, and unfortunately it is what it is. So we really have to take a lot of those government numbers with a grain of salt. And when you see higher interest rates, it means the government is paying a lot more in interest on debt. And when you have trillions of dollars in debt and you're paying a much higher interest rate, this is inflationary. We're seeing a lot of things. For example, the Social Security income went up by 8.7% in January. Well, you can't make food and energy and things out of thin air. And so just giving people more money is going to cause prices to go up. And especially people on Social Security, when they collect that income, they're going to spend it all. These people aren't saving for their retirement. They're in retirement. So they're going to spend all this extra money, which is just going to cause higher prices. So the Fed's really stuck between a rock and a hard place. You've got a situation where inflation is continuing to be a problem. So the Fed has to keep raising rates and has to try to get inflation under control. Meanwhile, you have all this recession data coming in that we're going into not a soft landing, but a very hard landing recession. So combining all this together, what I believe is going to happen is they're going to keep raising rates. They're going to keep trying to fight inflation until we have a major financial crisis. The market really starts to drop. We start to have major unemployment. And then all of a sudden, they're going to have to pivot. They're going to have to bring stimulus in. And that's when the inflation really takes off and gets a lot worse. And inflation ultimately wins. At some point, the government's going to have to cut government spending. They're going to have to raise taxes. So we're going to have to do everything we can on our investments with this in mind. So we want to have a lot of hedges against market risk. So we love the buffered index. We love the guaranteed, multi-year guarantee annuities at 5.4% or even 5.15. Keep in mind the 5-year looks like it's still going to be available at 5.55. So that's a great option too. Guaranteed 5.5% for every year for 5 years with no fees, no risk. So we're going to be positioning all the accounts. We're watching what's going on. I know it's not great news. This is not a good market update for most people, but we want you to understand what we're seeing in the data. It does not look good, and we're doing everything we can to position you in value stocks, high quality, dividend plays, buffered indexes, annuities with protection. If you have any questions or concerns, call our office and we'll be happy to talk with you and make sure your accounts are dialed in with what we're seeing in the markets. And hopefully in future market updates, I can provide some better news than what we're currently seeing. So thank you all for watching, and I hope that was a good market update.